Rates are at their lowest point in history, but how do you know when you're supposed to refinance? Hey guys, it's Brett. Thanks for joining my show where we talk about money and how to use it. It's March 2020. We're mid kind of pandemic. The Federal Reserve has cut interest rates combined in the last week, 2 separate cuts, a total of 1.5%. What does that mean? Well, it doesn't mean a lot for us in our everyday life unless we're trying to borrow money. Now, the Federal Reserve interest rate doesn't directly impact mortgage rates, but it is one of the indicators that helps influence mortgage rates. And because they've gone down 1.5%, 150 basis points in the last couple of weeks, we've already hit an all-time low. We are likely to see more lows. Right now, interest rates are hovering around the low to mid 3% range on a 30-year fixed rate mortgage for someone who's in good credit. That is insane. When you look at the scope of the last 30, the last 40 years, these interest rates are insanely cheap. They are insanely low. 3 anything is a low interest rate. Just to give you some context, in 1980, the average was 12.7%. 1990, 10.05%. In 2002, it was 7.5%. So there was a trend of them going down. In 2019, just last year, the average was 4.25%. Without going into too much detail, the rates aren't going to go too much lower than they are now. We're pretty close to about as cheap as you can get. So how do you know when you should refinance? Well, real quick, if you have an interest rate over 5% and you have reasonably good credit, you should refinance. You could probably save over a point, which is gonna save you significantly on your mortgage. If you're worried about upfront cost, maybe you don't have a ton of extra cash, typically they roll the loan fees into the loan, so it doesn't cost you anything. There's nothing out of pocket. As a general rule of thumb, if you can save 1% in interest, 100 basis points on your loan, for example, going 4.5% to 3.5%, it's almost always in your best interest to refinance, assuming you have a good lengthy loan left over. It's almost always going to work in your favor on the long haul. But if you want to see exactly what your savings are going to be, just Google refinance calculator. You can put in your current loan terms, you can put in your new prospective potential loan terms, and it'll compare it. It'll tell you, what are your loan fees. It'll show you where you break even. I'll have a reference to one of those in the description below. If you bought 3 to 5 years ago and you're still paying PMI or property mortgage insurance, which is I hate it. It's essentially just wasted money. But if you're still paying property mortgage insurance, you might consider refinancing just to get an updated appraisal on your house. Most markets all over the country have gone up multiple percent in the last couple of years, if not double-digit percent in value. Now let me give you a personal example of what I'm talking about. A couple years back, me and my wife were broke, but we decided we were going to buy a house anyways for some reason. So we put 3% down on a mortgage, which is the minimum amount that you can put down. And so we had PMI, we had property mortgage insurance tacked onto our monthly mortgage payment. It was about $110 a month, so roughly $1,300 a year, just in pure wasted money. Well, after about 18 months, our house value had gone up about 12%, which I'll admit is a pretty substantial increase in just 18 months, but we live in California. The market was warm at the time. So refinancing after 18 months in our situation got rid of the PMI entirely. I saved $110 right off the top in property mortgage insurance, and then I also actually shaved 0.5% off of my interest rate. So if you bought 3 to 5 years ago and you're still paying PMI, check out the rate. See if you can get a better rate. Odds are you're going to have a more favorable appraisal. You might even break that 20% equity mark. You can get rid of your PMI entirely. Sometimes people will give you different rates for PMI. So if you're close, let's say you have 15% equity, so your loan to value ratio is 85-15, 15-85. The PMI on that, it might be cheaper than if you only had a 5% equity. So even if you can't get rid of PMI entirely, talk to your broker. You might be able to get a lesser reduced amount of PMI. Instead of 100, it might be 60, it might be 30. If you don't know what your current loan to value ratio is, if you don't even know what that phrase means, just take your current mortgage amount, whatever you currently owe on your house, and divide it by whatever you think your house is worth. You can check out Zillow or Redfin to get a rough idea. It'll give you a rough idea of what it's worth, and that will give you your loan to value ratio. So for example, if I owe 300, My house is worth 400. I divide 300,000 by 400,000. What's the math on that? Shoot. Okay, 75. 75, all right, 75. You're gonna get 0.75, that's the loan amount. The other amount, the value, because it's a loan to value, the value is whatever 0.75, whatever you need to add to 0.75 to make 100. So that's an easy round number, it's 25. So in my example, I owe 300, house is worth 400. My loan to value ratio is 0.75 to 0.25. So I have 25% equity in the house. You want your loan to value ratio to be at least 80 or below, meaning you have at least 20% in equity or more. Another thing to consider is if you bought a 30-year mortgage a while back and maybe times have changed to make more money now, maybe you think about refinancing that into a 15-year mortgage. 15-year loans are super cheap right now too, probably gonna get one under 3%, which is just insane. Plus, you pay off your house faster. You get out of debt quick, and then after that, there's no hurdle to building wealth. When it comes to paying off your house early, there are multiple schools of thought. Some people don't want to pay it off because they say, this is the cheapest money I'm ever going to borrow. 3.5%. Dirt cheap. And so they'll say you might as well use the extra money in your budget to invest in other things to make more money than 3.5% down the road. The other school of thought, the other group of people will say the number one key to achieving financial success when you're in the middle class is getting out of debt, is paying off your debt. And so if the house is the last thing that's holding on, they say get rid of it, and then after that you can build wealth like nobody's business. Personally, I land somewhere in the middle. A home mortgage is the cheapest money you're ever going to borrow, that's true. But if you're eating away the extra money in your budget by going to a 30-year versus a 15, then there's not really any financial benefit to choosing the 30-year. You're just wasting the money. Personally, what am I doing? Our family's on a 30-year loan, but we're investing 15 to 25% of our income on a monthly basis every single month. So we're literally taking what could go to the extra mortgage in a 15-year, we're investing that in other places to ideally make more money. If you have that kind of discipline and you're able to do that, 30-year might be right for you. If you know yourself and you have a tendency to spend extra money when it's laying around, think about going to a 15-year. When it's on a 15-year mortgage, you're gonna pay the mortgage. Use a little bit of self-awareness, figure out which one's best for you. The last thing to note when considering a refinance, your mortgage, your total mortgage, so meaning mortgage, principal and interest, taxes, HOAs, Mello-Roos if it applies, home insurance, all of that combined together should be no more than 35% of your income. Ideally, it's 25% of your after-tax income, but really no more than 35% of your after-tax income. You go too much farther than that, and now it's just going to hinder you from building wealth in other areas. You'll be house poor. The magic number is really about 28%, but if you're in California like me or New York or some of the other high real estate areas, you're probably going to be a little bit closer to 35% of your after-tax income. Again, you don't want to go over 35%. Then it starts limiting your ability to live life, your ability to plan and invest and live your future, and life's to enjoy. There's nothing great about living in a big fancy house but then not being able to afford to do any of your other dreams. All in all, it's a great time to refinance. If you have specific questions, feel free and drop them in the comments below. Also, be sure to like and subscribe. It helps me out, helps the channel so that I'm able to continue to create content.